Now, on to today's market movers with easy to follow futures and options trades, and the topic is tariffs, brought to you by CME Group.
Welcome to Market Movers. I'm Jim Iuorio, and today we're talking about tariffs and the potential for a trade war as we're coming closer to the actual implementation days of these tariffs. We're looking at using 10-year options to either hedge risk or create exposure to a potential resolution. Joining me is CEO of KKM Financial, Jeff Kilburg. Jeff, glad to have you.
Hey, Jimmy, great to be here.
Okay, so first of all, I'm getting more worried about tariffs. I think it's real, and I think the escalation could happen. Are you with me?
I think there's some anxiety, and you're definitely seeing in the market. You did see a little bit of a reversal specific to the NASDAQ 100, but when you talk about trade tariffs, let's be honest and look at 2017. We, the U.S., are at a trade deficit of about $552 billion. 60% of that is with China. So this initial July 6th implementation of only $34 billion on these Chinese products, there is reason for concern, but I think it's in 1 or 2. That's my point.
Okay, yeah, but I just am worried about the direction of it, and I think I'm going to stay worried about that. But I like what you're saying. It calms me a little bit. Now, does the Fed?
It's good that you're calm.
Does the Fed have to respond at some point in time if this gets worse?
I think the answer is yes to that. I think the Fed responds all the time in some form or fashion. So I think the answer is yes to that.
Now, before we dive into our trade discussion, I'd like to point out, as with all market movers, it's important to view these as examples that allow you different ways to use futures and options products to either manage risk or create additional opportunities, not as recommendations or advice. Prices and movements will vary. When we price this now, the SEP 10-year was trading 120.08. Jeff.
Well, I think the trade example I want to look at right now is I do not see yields going lower. Other words, I don't see more buying. I think they'll see the anxiety come out as the weekend comes upon us. So I want to be selling the week 2 July 121, 120.5 call spread. That's for about 8 ticks. So I'm going to collect 8 ticks. This trade expires July 13th. And the underlying, obviously at 120.08, this trade risks about $375 to make 125. So therefore, it's not at the money, Jimmy, but at the end of the day, I think yields may go up a little bit to kind of stay sanguine.
I like this trade. And people sometimes look at the risk reward and say, well, you're risking more than the reward. But that's not the point, because it's all about probabilities. And the probabilities
and where the market
are in your favor. And where the market is. And I like selling it. I'm in the same direction as you. I'm going to look at it a little different way. But I like your way of selling it to 8 ticks and then collecting that decay if nothing happens. I'm looking at buying the week 3 July, so a week further than you. And I'm buying, so I want a little bit longer time.
That's right.
The 119.5, 119 put spread for 4 ticks expires July 20th, the week after Jeff's. 120.08 underlying. It risks the $62 you put out to make a potential 438, Jeff.
This makes a lot of sense, and I think when you see any type of a reaction, it's going to be in the Treasury market. I know everyone focuses on the U.S. equity market, the S&P 500, but the Treasuries continue to provide the leadership. So this makes a lot of sense, as it seems that front end of the curve certainly isn't stopping, but that long end of the curve, maybe it's time for the buyers to kind of abate for a while.
Okay, in a short answer, are we both, I'm saying it because I think risk on is going to come back to the market and trade tariffs are going to probably start to be talked about less. Do you agree with that, equity markets wise?
Well, I'm going to give you the long answer. No, I'm just kidding. I'm going to give you the short answer. Okay. I think you're right. I think a lot of the emotion in the market right now is due to the anxiety associated with the trade tariffs, but I think this $34 billion, that is just a drop in the bucket. I don't think it's that big a deal.
Okay, good. Thanks for joining us on Market Movers. I'm Jim Iuorio, where we are helping to make you a better trader.
Check out businessfirstam.com to find out where to see our entire show. And don't forget to like, follow, and share Business First AM.